A bad recession environment is a really bad one for markets. A soft recession where people were somewhat expecting something, it already priced into the markets. If you think about the markets being down last year anywhere between 20 and 30%, depending on which market you're looking at, someone already priced in. And the market looks out 6 to 12 months ahead of where the economy's at. So if we think there's a recession happening maybe in the second or third quarter of this year, and then it lasts for 6 months, the markets are almost already pricing past that.
Thank you for listening to the Interesting People You Meet podcast. This podcast is sponsored by Newground Financial. Newground Financial is a full-service investment and insurance brokerage firm that specializes in employee benefit plans, corporate insurance, and retirement planning. Newground Financial serves the provinces of Nova Scotia, New Brunswick, PEI, Ontario, and Alberta. Find out more at newgroundfinancial.com. Thank you for liking, sharing, and commenting on the Interesting People You Meet podcast across all of your favorite listening platforms, including Apple Podcasts, Spotify, and YouTube. By doing so, you are ensuring that more great people just like you have the opportunity to hear from our guests. Thank you, and enjoy the show. Hey, welcome to episode 21 of the Interesting People You Meet. Today, we have myself, Nick Momberket, our co-host, Nathan Dover, and our guest of honor here, Sadiq Adatia. Sadiq is the Chief Investment Officer with BMO Global Asset Management teams, and he sits on the BMO Global Asset Management Executive Committee. He's responsible for overall investment strategy and risk management across BMO Global Asset Management's investment solutions. He oversees asset allocation, portfolio structure, trading, portfolio analytics, and investment governance across all traditional asset classes. Sadiq joined BMO in 2021, bringing with him a strong knowledge and expertise in managed solutions, risk management, derivatives, and tactical asset allocation. Sadiq's investment knowledge is widely sought after in the broader investment community by media outlets such as CNBC, BNN, Bloomberg, and Reuters. Before joining BMO Global Asset Management, Sadiq was a chief investment officer at Sun Life Investments and Russell Investments Canada. And prior to that, he worked at Mercer as business leader for investment consulting for Central Canada. Sadiq holds an Honours Bachelor of Mathematics degree in Actuarial Science and Statistics from the University of Waterloo. He's also a CFA Charter holder and is a fellow of both the Society of Actuaries Investment Specialty Track and the Canadian Institute of Actuaries. Sadiq, welcome to the podcast.
Thank you very much. Appreciate that.
Yeah, for sure. Well, Sadiq, we want to respect your time and kind of get right into this. I know we have a lot of great questions to ask you, and we'll try and do as many as we can. But the first one here is a bit of a selfish one for us hosts. As younger advisors in the industry, certainly experienced advisors, but definitely bringing some youth to the table. We're always curious, how does someone get into a position that you're in right now? And so maybe you could share a bit of your story, your career path and trajectory that led you to the position you're in right now.
Yeah, no, that's great. It all starts off from, my days of just loving mathematics and statistics. So I went to the University of Waterloo to do an actuarial science degree. And as you might know, that's not necessarily the most attractive job when it comes to what people think of you as a person. But it definitely is a very good background for you because it gives you a lot of insights into many different aspects of the markets, from interest rates to what goes on in the equity markets to risk management, which I think is a very important part of what I think has made me successful up to now. But as I, went through that, actuarial program, I also got very quickly into the sense of I'm very much in tune to what is going on in the investment market world. And so not too long after making that transition and finishing off my exams, I started to go and write my CFA and get involved in the investment world. And I started off at Mercer, where I was a consultant. So this is where I got a lot of opportunity to understand pension plans, understand how pension plans work, but also how employees at pension plan were reacting and how they felt about their pension plan as well. And so, I've carried that part with me even up to now, where that risk management lens, the way of thinking about clients, the way I explain things, I really got from those years at my Mercer consulting days. And then after that, I moved over to Russell Investments, Sun Life, and then BMO. And the three have very much similarities in the sense of it's all investment focused. It's all about delivering strong risk-adjusted returns, and also making sure that we're always listening to you guys, the advisors, because you obviously spend a lot of time with clients, but also understanding the client angle to it as well too. And so that's how I started to transition from the love of math and statistics to understanding risk management to then really focusing on investment returns and trying to give the clients the best experience in multiple markets, not just in one trending market, but also in down, up, sideways moving markets. Try to eke out as much as possible of the returns, and that if you do that constantly, you should get pretty good results over the long term.
Nice, awesome, thank you. So for our guests, I guess our listeners, advisors and clients alike, one of the big things and the huge question I think we'll start with outside of your story is, what is the 2023 market outlook from your vantage point?
Yeah, I think obviously a much better one than 2022. So the bar was really low for beating what we had last year. But I would say, the reason why I'm optimistic is I think we get to the stage of, the Fed and central banks around the world getting closer to that pause in interest rates. And it's not that I think that, inflation is going down to 2% or, the economy is going to be really bad that they have to pause. It's more that they just have to be prudent and let all the rate hikes they put through just actually filter into the economy and see what sort of impact it actually has. Otherwise, if they do too much more, they risk, a really severe downturn, down the road. So I think, they will get to a pause just to let things go and then wait and see how inflation, how the economy, how the consumer, plays out. On the fixed income side, I think what you see is, again, because we're not going to see significantly more hot rate hikes from here, that you get closer to that peak of, the central point of where banks rates are going to be. And at that stage, I think also the yields are much higher, which now makes bonds more attractive again. And they're also going to be a lot less correlated with equities than they were in 2022 as well. So they come back to that diversifier. They go back to becoming a better yielding product. And then the risk side of it is a lot lower because of what we've seen, last year. So, it also makes a better bond market as well as an equity market this year.
And all that being said, from an advisor standpoint, one of the things that I struggle with is, does the 60-40 portfolio still make sense during these different market conditions? And last year with bonds was like, what do we do? So do you want to touch on that a little bit? Yeah,
sure. I think, last year definitely it didn't work because, again, the diversifier part didn't work with bonds and equities. But I don't think that's gone or broken completely. I think that was just a 2022 phenomenon. And I think that as we look into this year, it will start working again. Does it mean that some of the makeups of equities might change? Sure, and some of the bonds? Maybe. Should we add more alts into portfolios? Absolutely. But we've been saying that for the last 10 years. And you have to find the right mix of what makes sense and what, again, is a diversifier from the broader market. But I do think that generally what you will see is, a better environment for the 60-40 portfolio going forward. And it's because the bond environment is going to be much better going forward than it has been. We went through severe, rationalization of what happened in the bond market when rates went lower, and now we're just reversing that as rates go back up, last year. So I do think it will work, and I think the key there is just to stay the course, and in dips like 2022, find opportunities to add to your position because the rebound does happen. We've seen it time and time again.
Mm-hmm.
Okay, that's interesting. And one thing that we were kind of curious about too is we know that different countries can definitely affect the markets. And from an advisor standpoint, and like Nick mentioned too, from a client perspective, which countries or even different regions are you excited about right now, and what do you expect them to do in the next year?
Yeah, I think if you asked me that question last year, the answer would be completely different than it is this year, right? Last year, it would have been more overweight Canada, a bit more cautious on the US, more cautious on international markets, and also cautious on emerging markets. this year it's almost reversed a bit of that. We're very optimistic about emerging markets as China reopens, and I'll get a bit more to that in a second. We're neutral on the U.S., and that's kind of balancing off a little higher valuations, but also that the economy is a little bit stronger in the U.S. And the consumer is stronger. International, we brought up just to neutral last week, and that's because though we do see still some issues there, we do think that maybe the winter's going to be a little warmer this year than expected. That should help a little bit from the energy perspective, and the valuations are really compelling as well. So we do think that maybe the market is already pricing a lot of bad news there, and that maybe we want to start to dip our toes back into the international space. And then Canada, all of last year we were overweight. We're bringing that to an underweight now. We still like energy, but where I think the worry to us is that the Canadian consumer is starting to weaken up a little bit, and the Canadian consumer is a bigger part of the economy in Canada than in the U.S. or other parts of the world. And so we're seeing housing decline. We're seeing, again, more negative impact on higher debt levels. And all of that will eventually start impacting, how growth, plays out in Canada. So for us, it's starting to, take money off the table there and be a little bit more cautious. I don't know when exactly that downturn will start to happen, but I think, we don't want to try to be really, specific on that and start to, slowly underweight Canada versus the rest of the world.
Okay. I know this is a big ask, but if you had to predict the next 5 to 10 years in the markets, kind of whether that be based on different sectors or just the financial industry as a whole, like what do you expect to see kind of as a trend for the next 5 to 10 years?
Yeah, I think you're going to continue to see growth and innovation happening across the world, right? Because innovation doesn't change. Innovation is not just about technology. It's about every sector innovating, whether it's digital or trying to get more onto their the websites of internet sites, social media, same thing as well. So to me, innovation is going to be the growth story for not only the next 5 years, but probably the next decade. And I think what happened was we did fast forward a little bit during COVID because everybody had to, but that just highlighted the embracement of technology and innovation a bit more than what might have otherwise happened. That actually leads out to a really good outlook going forward. The second thing I would say is, we unfortunately are going to move back from globalization to internalization. And that's because of the supply chain issues. That's what happened with COVID. So I think you're going to see a bit of that come back over the next 5 years. 10 years or 20 years out, we might reverse back that again when it comes back to margins again. But I do think you're going to see a bit more of that, and that will be a trend going forward as well. So you've seen that with the semiconductor space, and you've seen that a bit with healthcare as well.
Okay. That said, you kind of alluded to it, but what sectors are you currently overweight right now?
Yeah, so we like energy still. I know we've had a pullback early this year, but if I look at energy, I look at it 3 things that are positive. First, supply, is still relatively low. There's not a lot of inventories out there, so that bodes really well that if you do have a demand pickup, that supply can meet up with that. And on top of that, if you compare it to where oil prices would have been traditionally, oil supply would be traditionally, given this higher oil price that we've seen, we would see a lot more inventory being built up. We'd see a lot more production, but that's not happening. So that, again, bodes really well that we will have limited supply. On the demand side, we could see demand come off because of the recession worries that might be out there, and I think that's why we've seen come off. But if China reopens and we've got the COVID policy now behind it, that's a big boost coming out of China. And that should more than offset the recession concerns, especially because we think it's going to be short-lived. So therefore, demand is going to be, probably what it might have been last year, but supply is not there. And that still means to me that oil prices go much higher than they're at today. So we do like, energy particularly. And I should also add that the energy companies, are much stronger balance sheet wise, which means we're going to likely see more dividends being paid out, which again supports their, price levels as well. And then healthcare is another area that we like. I think, when you think about healthcare, underinvested, we know the money's moving to that space. I think that it also has, a better immunity to the economic environment. So if we do see an economic slowdown, we should still see money moving into the healthcare market. So we see that as a great opportunity. And something that we're looking at a bit more is industrials, more defense spending, where we've seen everywhere around the world adding more and more towards that. The Russia-Ukraine situation is highlighted that you need to add more to that. So those are areas that I think we do like heading into 2023.
Awesome. And you touched on it, and it's sort of a basic question, but recession is a word that gets thrown around, and the general public freaks out when they hear about it. So how can you calm the nerves of those who hear that word, and maybe perhaps even just in layman's terms explain what that looks like and how perhaps that compares to a bear market over time, as an example?
Yeah, so a recession to me, there are technical recessions, which is what the economic indicators show. There's recessions that you actually can feel, and I don't think right now anybody's feeling the recession at the moment. To get to a proper recession where you're feeling hurt by it, there's job losses, there is wage that are coming off, and there is a housing market that's generally coming down as well. Now we've seen the housing market part, but we haven't seen the massive job losses, and we've seen some, but we're in a great position on job market, and we're probably going to move down to a good one. So yes, it won't be as great, but it's not going to be bad, and that prevents a very bad recession environment. A bad recession environment is a really bad one for markets. A soft recession where people were somewhat expecting something, it already priced into the markets. If you think about the markets being down last year anywhere between 20 and 30%, depending on which market you're looking at, someone already priced in. And the market looks out 6 to 12 months ahead of where the economy's at. So if we think there's a recession happening maybe in the second or third quarter of this year, and then it lasts for 6 months, the markets are almost already pricing past that. And so that to me is the difference between a recession and where the market looks at it. It's just the timing of the two. And I don't expect to see a very severe recession by any means, because the consumer, still has their job and they're still, spending. And last year they just depleted into their savings.
Mm-hmm. To switch gears a little bit, the financial services industry is changing. It has changed. So I'm just as we predict or try and put on your look at the crystal ball here in the next few years, 5 to 10 years, be it. How do you see this industry changing over time?
Yeah, regulation continues to play out there a little bit, but I also think the digitization of how banks are formed. If you think about the PayPals of the world, or Squares, they're a different form of the traditional banks. But I think generally that there is still strength in what you see in the traditional banks or asset managers that are tied within banks, because I think they have a lot of strength in dealing with the consumer. And I think at times like what we saw last year, that consumers want to talk to someone. They just don't want to be just purely online and just hearing things from someone they don't know or reading something they don't know. And so I do think that there's going to be a transformation for sure, but I don't think it's going to go as fast as people think it's going to go. And it's because of what happened over the last couple of years, where the market swings have got people nervous. They want to see where their money's at. And I think it's going to evolve, no doubt about it. But I think it's going to take a little longer than people are expecting. And I think the other part to understand is that people are looking at trying to bring all their assets into one place. So when you think about some of these other companies that we talk about, the fintech world, I don't think that's possible in all of them at the moment. And so do you want to have your thing in 7 different places and then have to look at each one of them as you do your financial plan, or you want to do so? To me, I don't think so. And actually, I think that's why the financial advisor is going to be that much more important going forward, because of what just happened last year. Because I think a lot of people who may have had plans of when they wanted to retire, may have got adjusted by that, because they were trying to time markets and do things, whether they were jumping in the crypto space or other, areas that got really hit really hard. I do think that it is going to evolve, but not as fast as people think.
And just on top of this, for the market, or I guess the industry changes, we saw in the last couple of years with COVID and just being able to do virtual meetings, kind of different regulations around how you can get it signed, whether that be in person or whether that be virtually for certain documents. just kind of going down that technology path. So how is BMO and how are you using technology to kind of to further your guys' innovation?
Yeah, so we're using technology in a great way to help us to cover more research, cover more insights, to look for key things that I think are important in a marketplace. Because without that, in AI as example, it would take you much longer to get through things, or you need to add significantly more bodies. This lets us be a lot more focused, particularly, and I'll highlight our new team on the technology side and the broader global equity team. They've been all over global innovation and AI in particular, and trying to incorporate it more in their process, and that's been fantastic. So it's definitely helping us from that standpoint. We will still do webinars, podcasts, other things as well. But I do think that we are seeing more and more advisors and end clients want to physically chat with us in person as well, to get to know a little bit more of the insights, to feel a little bit more comfortable. And so we'll definitely go and do that. So we're doing roadshows. We have a roadshow out east actually in the end of January. We did it out west in December and November. So I think it's going to be still a combination of both. I don't think the in-person stuff's going away by any means, but I think some areas where it's a lot harder to get in touch with people, or their schedule's a little bit more harder, you can always do the webinars or again podcasts as well.
Mm-hmm. I think this next question is going to relate to obviously what we talked about earlier, but also technology. So I've been seeing that there's been lots of layoffs in the technology world right now, and it seems like a lot of the big tech companies are downsizing. Is that coincidental timing to this forthcoming recession, or is that just the start of something that we're going to be seeing here soon?
Yeah, so if we think about the inflation situation that occurred all of last year and even before that, it started in the technology world. The bid up for talent, the prices that were going up like crazy, the stock valuations going up. So inflation was crazy through the door in technology first and foremost. And so just like it was the first one in, it's going to be the first one likely to come out of it. And so what we're seeing in Q4 was technology companies were the first companies to lay off jobs. Whether that was Microsoft or it was Google or Meta, and again, when I say technology, any technology-oriented company, even if they're not necessarily in the technology sector alone. So we saw that happening, and we see more of that. And you'll see now other areas do the same, in the coming quarters as well. So to me, it's just one of those situations where you have to eventually do that when inflation starts to impact the consumer, and you see demand softening, and you see your price point that you were selling things have to come down, which impacts your revenue. A combination of that means that you have to start cutting back on jobs, and it's a prudent thing to do. It's what the central banks are wanting to happen so that they can pause and eventually pivot, and that's exactly what you're seeing.
Okay.
But I don't think it's going to be a very bad job market. I think what's going to happen is you will see job losses, and this is a visual that I hope people can get to. Think about someone who has a great job today and making a lot of money, so they're spending pretty freely. What will happen in about 6 months from now is a few of those are going to lose their job. Okay, but again, not a lot, but a few will lose their job. So they'll go from having a lot of money to now no money coming in. So they will tighten up their spending. But there are a lot of jobs still available in the service sector. So think about travel and tourism is a good example. So they may pivot if they need a job to something that's a little different, but because it doesn't require a lot of training and a lot of of the educational background that would have otherwise required in a more sturdier job, they will take that job relatively quickly, get paid a little less. But what will happen now is their spending pattern won't be like it was when they had their original job, but it won't be zero spending either. It'll just be tighter spending on necessities coming forward. And that's what I think will happen. So even though the job market might look like it's not as weak, it will change from some higher paying jobs to maybe some lower paying jobs.
Interesting.
Sadiq, all that being said, I'm just to switch gears a little bit more about keeping on tech and this whole crypto situation that has occurred. I've been reading through the book Values by Mark Carney, and there's a chapter on it on crypto, which is quite enlightening. And it just talks about the digital currencies itself and where they stand and the different types. So I'm just curious, what's your take on crypto right now? And is it some, I know some have been discussing it as perhaps a hedge. And, what do you see that, that whole conversation looking like right now?
Yeah, I think crypto, like any other asset class, you have to look at and decide, does it make sense within the portfolio, and what is the upside and what's the risk side of it as well. And I think, to me, the risk side are still pretty high. And we saw some evidence of that just recently. Regulation is a big part. Until you get regulation, the volatility spectrum and some of the unpredictability of it is there. And that's hard to then forecast. And it's hard to put into a portfolio. So to me, that's a big part of why we don't have it currently in our shelves. The second part is just the fact that because it's not regulated in the same way, and it's not just the cryptocurrency, but it's the exchanges that use it. So we saw what happened with FTX. You can't control it because sometimes they're not in the North American market. And what goes on in another part of the world is different. And again, you can't keep the eyes and track everything carefully. You just don't know where your money's at times. And I think that's another part that you have to be very careful about. And that, yes, applies to cryptocurrency, but maybe even other aspects of other asset classes as well. Do I think that crypto's gone? No, I don't think so. I'm actually surprised that, Bitcoin is still at 17,000. With all that's gone on, I would have thought it would have gone down to like a 5,000.
Mm-hmm.
And so I do think that the fact that it's at 17 says there is a bid level here, and people are looking at it once again, and will look at it. You might not see a ton of money going in at the moment until the FTX is completely cleared out, and we see some other maybe fallouts that might happen, which I think will still, but again, I don't know what extent of that. But I think things like blockchain or even Ethereum have a bit more validity because they're using multiple sources. Which I think plays out a little better out, whether it's purchasing or the NFT world or meta world. I think those things continue to have some sort of life behind it, particularly I think the meta space. But again, a lot of it's tied to, similar technologies behind it as well.
Awesome. Thank you. Are there any other trends in the market that you think are important to consider right now that we haven't touched on?
Yeah, well, I still think the metaverse is something that's important that, will play out. Is it going to be in what we see today? Probably not. I mean, I go back to the late 1990s, when we talked about internet and, buying things online. Though the next 5 years, that didn't really happen. It did eventually happen, right? And so that was the great news, that the thoughts were happening, just took a lot longer to expect. I think what happened is, though, the innovation cycle took a lot longer in the 1990s, a little less in the 2000s, a little less in the 2010s. And very quickly in the 2020s. And so I think that, with Meta, it won't take a decade for it to finally form out the way it should form out. It probably will take a couple of years. And, what happened last year where people have to pull back their spending has paused that a little bit, I think. But I think that's another area. And cloud. I think the cloud was something that was growing last year and the year before. I think we've seen some spending come out of it. But that's going to continue to move forward. As well too. So those are the areas I see a lot of operation, sort of money moving in across the board. And then clean energy is another that I think we'll continue to see some momentum. I don't think the ESG situation is dead. I just think it's going to get revamped a little bit because people still want to invest, with their heart and, where their social conscience is. But they're now aware that might mean at a cost of returns at times. And so, balancing that out a little bit better, understanding that, I think we'll reestablish the market at a different point later on.
You touched earlier on AI. Do you have any more comments on that? It's growing at a rapid rate and teaching itself now. So is that a scary thing for you, or is that thumbs up? Let's see how that goes.
Yeah, some people think of AI as potentially taking jobs, right? And it might do that. I won't say it won't. But at the same time, to do AI, you require a lot more individuals, and again, they become higher paying jobs, which I think is great. The other part is it creates outcomes that possibly were not possible before. our healthcare guys and our technology guys had a great example of, there was this, they're trying to create, the source on the healthcare side of trying to find, things that you can build a vaccine from. And it starts off with, DNA and other things going forward, and to create, a whole bunch of patterns that eventually form something. And that might take, all the healthcare professionals and scientists and all of that, decades to do. But AI could start to form patterns and do things quicker that might take us a year or two to do. So it means that we may never got to some of these solutions at all that we will now. So it maybe not necessarily, take away all the jobs, it might create new jobs as well and new inventions that again will help, the end client, but also the general consumer that is looking in that space as well. So I think that AI is here to stay. AI is actually a very good thing. It's going to make outcomes better. It's going to make our lives better. It's also going to take, what we do today to the next level. And I think that's a very exciting thing going forward.
Awesome.
Yeah,
go ahead, Nathan.
Yeah, no, I was going to say, I think the whole AI thing's really cool right now. And I mean, for the most part, as of right now, it still seems to require a lot of human input. So it's not really free thinking as the movies may say, or what we may expect it to look like in the next 10 years or so. But I thought that was very interesting. But I just wanted to go back a little bit to Meta, because I'm always curious to see what your thoughts would be on, like, do you think the metaverse could become some form of like a centralized location to do banking, to do business? Like, do you think the financial industry could actually take footing inside the metaverse?
All of that is possible. I don't know what the final shape will be, but there is a world there where, you have real estate there, you have advertising in there. I mean, just think about it a little bit as people are, I'll use, kids that I know, and that when they play video games, they're online a lot, right? And then they're, looking at things. Now, if there was I'm going to throw out Nike, but I'm not endorsing Nike here. I'm just saying that. But if there's a Nike sign on there with some cool shoes, all of a sudden, they'll see it 1,000 times when they play that game. And maybe they will relate someone to go out and buy that. Or that maybe they can pay a little bit of what they're utilizing in their coins or whatnot for their avatar in there to wear that shoe. So, and that's going on, as we speak already today. Mm-hmm. That might become much more broader scale. And, it could be a real estate market in the metaverse, similar to what we see today outside in the residential world or the commercial market. So I think the possibilities are endless. I just don't know exactly how big that will be, but I do think it's going to be there. It just, again, still in the early infancies of that. And, you've already seen a lot of people make big investments in that.
Yeah, like my thoughts are like, why not in a few years, depending on obviously rules and regulations, like why couldn't I have a consultant meeting or meet with an advisor for straight up virtually? Like you could go right into their office, into the metaverse, and you both have your headsets on or whatever. I think that'd be interesting to see how documents could be signed and conversations could be had in there. But this is my 2 cents.
Yeah,
I love your mind, Nathan.
Yeah, and I think especially I think that the younger workforce is already into that space already, right? So it's not like you're gonna you might still have to be with your older older clients. They might select a traditional way, and the younger ones might. So you have to be adaptive to your clientele. But I do think that that the future is going to look a lot different than what we are seeing it at the moment.
Sadiq, we've covered a lot of ground, and we really want to respect your time. I just want to end off with one last question, and that is, you interpret data and share it with your teams and the country at large, and I'm sure you're asked a million questions. What's a question you wish people would ask you more often?
I think people should always ask me the question of, what is the risks that you could see out there, that either are priced in or not priced in, but that you have to monitor along the way. To me, the risk is that inflation stays higher for a longer period of time. And even though the Fed will pause, I'm very confident about that. The pivot may not be as quick as people think it's going to be. And if that's the case, that means, mortgage rates stay higher than expected. your debt levels will remain high because you'll be paying more from an interest rate perspective than actually paying down that debt. And that will eventually mean that we will start to see more job losses continuing on going forward as well. That is a big risk there. I think also what happened with Russia, Ukraine, the geopolitical risk, I think people have almost forgot about it again, but it's really an important one that won't go away. We don't know what will happen with that eventually. Will China and Taiwan start to do something? And is there someone else out there that is potentially cause, other problems down the road? And of course, politics is another big risk that I think people forget about. And I think we saw some evidence of that as they're trying to pick up the speaker in the last few days. That took 15 attempts. But it tells you that how hard it's going to be to put policy through, and sometimes you have to give up to get a vote that might have consequences as well down the road. And with elections coming around the corner, and who might be the leading candidates and who eventually wins, I think there are risks that are quite abundant there. And of course, the last one is just all the amount that we've spent during COVID to get the economy working that we will have to deal with down the road as well. So there are lots of risks that you have to watch. The question just becomes, are they priced in? What could be the worst case scenario? And try to put that into your forecast as you decide how much you want to be overweight or underweight, the equity markets, or where we want to be in the bond space as well. I wish people were a bit more watching on the negative side a little bit more, because it's not the same as going up 20 and down 20. It's a lot harder, right? You have to if you go down 20, you got to actually go up more than 20 to win back. People always forget about that little easy mathematics that actually does impact you a little bit more.
Absolutely. Well, thank you. Episode 21 of The Interesting People You Meet with the Chief Investment Advisor of BMO Global Asset Management, Sadiq S. Adatia. Thank you so much for your time. We really appreciate it, and have a great day.
Thank you very much for having me. I really appreciate it.